Technology, our economic system, and money are each evolving 10 times faster than our education system's ability to teach the growth in technology, our economic system, and money, which means if you keep blindly following what everybody else does, you're going to keep falling further and further behind without even noticing it happening. Take a look. Starting with money, in the last 15 years, investing has become so much more accessible. This is great news for people who are investing their money, but for the millions and millions of Americans who don't know how to start investing, that means some people, the people who understand this, are becoming wealthier while you get left behind. With technology, less than 25 years ago, the internet was considered a fad. Let me actually read you this headline from a Daily Mail news article published on December 5th, 2000. The internet may just be a passing fad as millions give up on it. And today, the average person spends 7 hours a day on the internet. And then when you look at the economy, 50 years ago, one-income households in America had sufficient income coming in to support buying a home, buying a car, maybe 2 cars, going on a vacation once a year, and putting money aside for retirement. Today, we have 2-income households in America, and many households are struggling just to get by. We are living in a time where innovation and technology are evolving and growing significantly faster than our education system's ability to teach the growth in technology and innovation and money, which means if you don't keep up, you're going to be the one that's left behind. But here's the interesting thing. We're also not accustomed to change. We don't want change. That's why anytime you hear people talk about new innovations or artificial intelligence or new technologies, so many people become hesitant to the idea of adopting this new technology because what if this AI takes my job? What if this new technology takes their job? What are we going to do? I was talking to my grandfather recently. My grandparents were born in a state in India called Punjab before the Indian partition happened in 1947. They were born on the west side of Punjab. And I asked my grandfather for some reason about toilets. And one of the interesting things that he was telling me was that in my grandmother's village, when they were growing up, there was no toilets and there was no sewage system. Back then, if you wanted to go to the bathroom, whether you were a guy or a girl, you would just go into the fields and go into the bathroom. If you were a girl, you had to make sure nobody was around you. Guys, I guess it was a little bit more free for all. My grandfather told me that where he grew up, it was a little bit more sophisticated. Over there, they had buckets or these reservoirs where you could go to the bathroom. Pee or poop, doesn't matter. And then they would pay somebody every week to come and pick up the poop and take it away. They would have these crates or these reservoirs where they would carry the poop away. Well, guess what? Innovation brought toilets. So if you're happy that you have a toilet, that you don't have to pay somebody to come and empty out every single week or to come and carry the poop out, you should be happy that you have toilets. And if you say, but Jaspreet, I still have an outhouse where I go and poop. Well, be happy you don't got to go into the fields every single day. So if you're happy about toilets, remember, innovation can be a good thing. Now, this is where things get a little bit tricky because innovation always means that some people's jobs will be lost. Like when toilets came, that means the person whose job was to carry the poop out no longer had a job because now you had a toilet and a sewage system, but now the jobs evolved because now somebody had to manage the sewage system. Somebody had to install the toilets. And so jobs evolve with innovation, but this is where it's your job to keep up what's happening. When Amazon came into play, Amazon was great for consumers. I love Amazon because it made our shopping life so much easier, but it was bad for people who had mom and pop stores who couldn't compete with selling their stuff online at discounted prices. Uber was great for consumers. Anybody who wanted to go somewhere, Uber made it so much easier. But the people that hated Uber were the taxi drivers who had to mortgage their homes and borrow millions of dollars to go out and get a medallion in Manhattan. That way they can go out and become a cab driver. Innovation always comes at a price. And this is where now innovation happens. You have 3 responses. You can either embrace it, you can hate it, or you can be against it. The big and popular trend that we're seeing today is artificial intelligence. But of course, there's a big anti-AI movement because some people are naturally worried that AI is going to come for your job. But what I want you to think about is what if you were on the cutting edge of a previous big movement? Like imagine if you started a blog back in 2001. You would have ran a monopoly on the internet because there was very few blogs on the internet. So you would have been able to print money back in the early 2000s. Or imagine if you started a YouTube channel back in 2007, back when YouTube was begging content creators to come to YouTube, and back when they were asking content creators to publish more content because there were so many people that wanted YouTube, but there wasn't that much content on YouTube. Or imagine if you started a Shopify store or an e-commerce store back in 2012, back before drop shipping and Amazon FBA and all these e-commerce stores started flooding the internet. Or imagine if you got into Bitcoin back in 2015, back when Bitcoin was only a few $100s a coin. This is the power of understanding innovation before it becomes popularized by the rest of the world, and being able to embrace the idea of innovation, because the reality is innovation is going to happen. Social media is there. You can try to ban social media all day and night long, but it's there. You can try to ban artificial intelligence all day and night long, but artificial intelligence is going to keep growing and growing. You can try to ban any type of innovation, but you cannot out-regulate innovation. See, the problem is that technology is growing and expanding exponentially fast, but our education system is growing significantly slower. It cannot keep up with the growth in technology. I didn't go to business school, but if I would have learned about business, the things that I would have learned in business school would have been obsolete by now, because of how fast innovation is changing, because of how fast the internet is changing, because of how fast marketing is changing, because of how fast digital advertising is changing. And this is where the education system is struggling to keep up. And that's why so many people hate the idea of change, because we don't know how to embrace it. And so the current easy emotion to combat when you have these types of changes is don't let the change happen or ban it. That's why you're seeing people trying to ban artificial intelligence. You're seeing people wanting to ban cryptocurrency. You have people that want to ban social media because of its impact on your health. We as humans are not evolving fast enough to keep up with the growth in technology. That's why you have so many people who are becoming depressed and anxious, directly correlated to social media, because social media has been growing. Companies have been trying to maximize profits. They don't understand how to change their algorithms. While we as humans, as consumers of social media, are byproducts of the effects of social media. A social media company can only make changes after they see something happen. If they see people become depressed, they become anxious, they become suicidal, they become going through struggles because of social media, only then can they make changes about it. And many times they're not going to make changes until the problem becomes big enough that it becomes a public outcry. And this is where now you can try to ban the problem, you can try to ban the thing, or you can try to educate the consumer. Now, the problem is you can never ban the thing completely. You can't completely ban social media. You can't completely ban artificial intelligence. And even if you did, that's not going to stop them from existing or innovating. And this is why the education aspect is so important, because it is your duty to protect yourself. It is your duty to take care of yourself financially. It is your duty to make sure your family is okay. So that means you have to be the one that goes out and get educated. And that also means that you have to be the one who sparks the interest mentally to know, maybe I should learn how to use technology. Maybe I should learn how to use social media. Maybe I should learn how to use artificial intelligence. Maybe I should learn how to go out and use my money. We don't learn these things in school. We're not taught how to think in school. We're taught how to do. But the wealthiest and the most successful people are the ones that know how to think. Because if you know how to think, you're not going to know all the answers, but you're going to know how to ask questions. And if you know how to ask questions, you're going to know how to research, and you're going to be willing to learn. And the problem with today is we live in a society where we don't want to think. We're not taught how to think, and so we assume we shouldn't have to think. Instead, we just want to follow somebody else's opinions. One of the reasons why I always say never blindly trust a random guy on YouTube is because I want you to learn. I don't tell you, go do this with your money. I don't tell you, go invest in real estate and do this, or you have to invest in stocks like this, because your goals are different than mine. Your risk tolerance is different than mine. Your financial horizon is different than mine. What you want with your money is different than mine. Your experience is different than mine. Based off of that, you need to make smart financial education decisions. That's why you need to become financially educated. That way you can look at your family, you can look at portfolio, you can look at how you want to live, you can look at your risk tolerance, and then make a decision of how you want to use your money. That is what education is all about. But we're living in an age where we have all these tools and items around us. Social media has become so consuming of so many people. But if you don't know how to use it, it can take advantage of you. Some people are being taken advantage of by their social media. You're becoming a slave to your social media. You're becoming depressed because of social media. You're facing anxiety because of social media, because you're seeing social media which is a highlight reel. It's people posting their best aspects of lives. No one's really posting their real life stuff on social media. They're only posting the best things and the edited things to make their life look like a highlight reel. And then you compare what you see on social media to your real life. And now you say, where am I missing? Where am I lacking? How come I don't have this lifestyle that all of my friends have, that all these influencers have, that all these celebrities have? How come I don't have that? And now all of a sudden you start spending more and more time on social media because you can't go a minute without taking a look at your phone. You can't go to the bathroom without taking a look at TikTok. And now you keep going through it and you go deeper and deeper and deeper. And unless you know how to cope with it, and unless you can realize what's going on here might not be right for me, or it might not be reality. Unless you can make that distinction in your mind, you're going to become a slave to that platform. Versus some people understand social media and they're able to use it to their advantage. Maybe it's to make themselves famous. Maybe it's to make money. Maybe it's to grow their business. If you understand the technology, you can use it. See, everything has the ability to be a consumer or a producer. Just like that, you can either be the consumer or the producer. See, we're taught in our education system to go to school, get a degree, get a good job, and then hopefully one day be able to retire. And what happens along the way? Well, you go to school and then you get this job. Hopefully you're making decent money, but then you want to spend money. You're never taught how to invest your money. You're never taught how to build wealth. That's a producer, but you're taught to spend because that's all we see happening all around us. All of our friends are buying and financing the nice cars. All of our friends are going on the nice vacations. All of our friends are buying the nice homes even though they can't afford them. All of our friends are going deep into student loans to be able to get that degree. That way they can hopefully one day get a good paying job. That's what everybody does. And so we are never taught to be producers. We are taught to be consumers. Consume, consume, consume. Go to the store, buy the nice stuff. If you can't afford the nice stuff, buy now, pay later. Go to the Gucci store, buy the nice handbag. Can't afford the nice handbag, put it on your credit card. Go out and buy the nice big home. Can't afford the big home, get a bigger mortgage. Can't qualify for the bigger mortgage, get a second loan because it's normal. This is the society that we're living in. And when you do that, you become a consumer to society. You're just spending money, making everybody else rich. When you go and buy the home, you're making the mortgage banker rich. You're making the seller rich. You're making the realtor rich. You're making the title company rich. But it's at your expense. When you go out and buy the car, you're making the car company rich. You're making the financing company rich. But it's at your expense. When you go to Gucci, you're making the Gucci shareholders rich. You're helping the salesperson get rich. You're helping the landlord for Gucci get rich. But it's at your expense. And this is where now, financially, you have to shift from the consumer mindset to becoming a producer if you ever want to become wealthy. But in order for you to become a producer instead of just a consumer, the first thing is you have to realize something's wrong. I don't want to just keep spending all of my money. Now, maybe you start by just saving some of your money because you're like, you know what? I don't want to spend all my money. I want to keep some of it for myself. So you start saving. And then maybe if you're fortunate enough, you come across a book, you come across a podcast, you come across a YouTube video that sparks your interest to start learning about money, because we don't grow up learning about money. Unless you have rich parents to teach you about investing, financial freedom, wealth, cash flow, you're not going to learn this. Your teachers are not going to teach this because chances are your teachers don't know anything about this, because who's going to teach them? And so if you don't learn it, you're going to always be a consumer in society, financially. But that same mindset of just being a consumer applies to everything else. Same with social media. Guess what? The vast majority of people, not just in America, but around the world, are just consumers on social media. What are they doing? They're scrolling through social media all day long. You're at work, I'm scrolling through social media. I'm in the bathroom, I'm scrolling through social media. I got 5 minutes before my meeting, I'm scrolling through social media. Sometimes now when you're driving, I'm scrolling through social media. And so what does that do now? You become a consumer of social media. What are you consuming? You're consuming this lifestyle that all of your friends, family, and influencers are projecting, but you're also consuming all the products being sold on social media. You're also consuming the algorithms on social media. One of the very valuable pieces of advice that I learned, this is actually from Robert Kiyosaki when I was meeting him, was he was a big advocate of saying, learn from people who disagree with one another. Learn from people with differing points of view. If you hate their mindset, if you hate their point of view, learn from them. And the reason why is because it will teach you. You have to learn from people with different points of view. That way you can find where intelligence is. Intelligence is somewhere in the middle, but it will help you strengthen your argument, or maybe you will see their point of view as well. Today, guess what? When you look at the political environment, why has our politics become so polarizing, so aggressive? It wasn't like that 10 or 15 years ago. It wasn't like that before. Before, you used to be able to have debates and discussions to come to conclusions. You didn't have this massive polarizing difference between the right and the left. I didn't even know what the right and the left was until I hit college. Before that, everybody was just people. At least I thought I was a little bit ignorant as well. But we've become so much more polarizing again, then going back to social media. It goes back to technology. And this is where your job as a human, as somebody who wants to take care of their family, as somebody who wants to take care of their community, your job is to understand what's happening. Understand the changes that are happening. You can't always fight the changes, but learn how to accept and embrace them, because they're going to happen. Artificial intelligence is going to happen. Blockchain is happening. We're seeing different social medias happen. These things exist. And so instead of just trying to completely ban these things or being hateful of these things, learn about them. You don't have to spend all of your time on them. I have distanced myself from social media pretty drastically. I used to be very involved. When I first started the Minority Mindset brand, I was pretty involved in my social media. I was always on Instagram. I was always checking the social media pages. But I became so engulfed on social media that I realized it was unhealthy for me. And that was when I decided to step away. I told my team, I want you to manage my social media. I don't want to touch it anymore. I deleted Instagram off of my phone. I deleted Facebook off of my phone. I took off Snapchat. And it was the first time that I finally started to feel relief, because I noticed myself that I needed to keep checking my phone. I was at dinner with my wife and I would be looking at notifications. I'd be seeing how many likes I'm getting on Instagram posts. And she would always call me out. But then eventually I was like, this is not right. I should be spending time with you. I should be present here with you. But instead, my mind is over here. My mind is trying to guess how many likes I got, which is such a vanity indicator of anything. It doesn't mean anything. Likes don't mean you're making more money. There are some people with 5,000 followers that are making way more money than people with 500,000 followers. Yes, it's a fact. Can you make money with more followers? Absolutely. But you have to understand what's important for you. And your job now on the financial side of things is not just to be a consumer, but to be a producer. In order for you to be a producer, you have to understand how to use these technologies to your advantage. In order to use these technologies to your advantage, you have to get educated. We're not taught how to learn this in school, because school can't keep up with all these growing technologies. School can't keep up with the growth in artificial intelligence. School can't keep up with the growth in social media. School can't keep up with the growth in advertising and digital marketing, which means you're going to have to go out of your way to start learning. Now you go on to YouTube, podcasts, books to start learning. But then it's very easy to go down this rabbit hole of only believing one thing, only learning one side of things. But this is where now, if you really want to be fully educated, you're going to have to learn different opinions, different points of views on whatever it is that you're learning, whether it's artificial intelligence, whether it's money, whether it's investing, whether it's how you earn more money. Learn different points of views, because that's where the real intelligence is. Now, when you couple what's going on with technology and social media with what's going on in our economy, this is where it becomes exponentially more important. Because on technology, we have what's perceived as these idealistic lifestyles. And in the economy, well, we're seeing a lot of shifts happen in our economy. We're seeing people having to go back into the office. We're seeing some people having to work a little bit harder. We're seeing some people have to make more changes in their work-life balance. And that's making things a little bit more difficult. And this is where people are looking at social media like, wow, this person's traveling the world, living this lifestyle. How come I have to work into the office? How come I have to earn this type of lifestyle? How come I can't have what everybody else has? And the reality is, as you start to see shifts in the economy, as you start to see slowdowns in the economy, that's when the dancing and the party starts to end. And that's when reality starts to hit. And that's when the people who think that you should have this idealistic lifestyle, well, you start to see what reality really is. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. Our work culture in America is changing again. We went from the Great Resignation to quiet quitting to a new trend today called loud quitting. Now, if you're like me and you've never heard of the term loud quitting, let me read you exactly what it means from Good Morning America. Loud quitting is when people aren't just unhappy at work, they're resentful that their needs are not being met and they're acting out on that unhappiness. Workers in this category tend to undermine what the organization is trying to get done and share their discomfort with others in the organization and even outside the organization. In other words, loud quitting is people who are going around telling their employees that this work sucks, I don't like my job, this is too much hard work, I don't want to be here anymore, and then they're posting on social media that my company sucks. Here's the thing, there are two factors that allow these types of employment trends to happen. Number one is an employee's perception of their work, and number two is the employment climate. Now, if we start with an employee's perception of their work, if an employee feels overworked, undervalued, and underpaid, they're going to want to make a change or do something to potentially undermine their company because they're not happy at their job. But they only have the real ability to do that comfortably when you have number two, which is an employment market which facilitates these types of employment trends. Right now in America, we are seeing the strongest labor market that we have seen in decades. There are more job openings available than people who are looking for a job. If you are unhappy with your job, or if you don't like your work environment, or if you don't like going into the office, or if you don't like something about your office, you can quit. Or you could be fired, and it's not that big of a deal because there's 5 other job openings out there. Now, are they the perfect job openings for you? Maybe, maybe not, but there's still job openings out there because employers are looking for employees and there aren't enough employees out there. Now, from a purely economic standpoint, this is where it's important for you to understand how we got to this situation in the first place, because the reality is that this job and economic market is not going to last like this forever. Let's go back to the chart from the Bureau of Labor Statistics, and what you'll see is that in August 2013, there were almost 3 unemployed people for 1 job opening. Today, there's more than 1 job opening for 1 unemployed person. When did this change happen? After the huge unemployment spike during the 2020 pandemic. That brings us to the natural next question. What happened during the 2020 pandemic, which was the worst recession that we have seen since the Great Depression, to create so many more jobs? And there's really only 2 potential solutions. Number one is that there's not enough people anymore to fill the jobs, or there's way more jobs that were created during the pandemic. Now, if we take a look at the amount of labor that we have in America, back in 2020, there were 335 million Americans here. In 2023, that number had grown to 339 million people in America. So if our population is rising, that would generally mean that the amount of labor and workforce that we have in America is also rising. So the reason we have this flipped job market today as opposed to 10 years ago doesn't look like it's because we don't have as many workers today. That leaves us with option 2, which is we have more jobs available today than before the pandemic, which might seem a little bit strange when you consider that this pandemic was supposedly the worst economic downturn since the Great Depression. So how could we have more jobs created now than before? Well, thanks to your good old friends at the Federal Reserve Bank, the government, and the money printer. Between the years 2020 and 2021, the government created the PPP loan for businesses. They created free money through grants for businesses. They created bailout programs for other corporations. All this money creating and stimulus was a massive boost for the economy and bank balances, because now you had all these businesses that went from kind of on the verge of bankruptcy to being okay to now all of a sudden, after this money printing, having more bank in their accounts than ever before. So now when you have tens of thousands of businesses with a pocket full of cash, what do? They're going to work on creating new jobs. They're going to work on opening new stores. They're going to work on creating new products. They're going to work on investing in research and development. They're going to work on creating new manufacturing. All of a sudden, we saw this huge, massive boom in the amount of jobs out there because businesses were given so much free money to go out and do whatever they want with it. Some people obviously did stock buybacks, but so many businesses had the ability to go out and create jobs and create new products. But the kind of tricky part with that is when businesses create products, they need people who can actually buy these products. And if you're going through this massive economic slowdown where people don't have jobs, how are people going to create money or have money to go out and buy the products that all these businesses are now creating? Well, the stimulus wasn't just for businesses. The United States government, with the help of the Federal Reserve Bank, passed stimulus bill after stimulus bill after stimulus bill, which created trillions and trillions of dollars of new money, new infrastructure programs, new job programs, new unemployment programs, new stimulus programs that way now people also had the ability to get some free money. In fact, many people during the pandemic were making more money in unemployment than they were working a job. Now think about that for a second. The government doesn't have any source of income. The only income that they get is from taxpayers through tax dollars. But already the government is spending more money than they bring in. That's why the government has this massive amount of national debt. That's why the government has this huge national deficit. That means they spend more money than they bring in. So the government doesn't have money to spend as it is, and then they're spending trillions and trillions of dollars on stimulus. Where does this money come from? The Federal Reserve Bank has to print it. So now the government doesn't have money to spend, but they pass these multi-trillion dollar stimulus programs, which gives free money to everybody. Now, all of a sudden, people who didn't have jobs, who weren't working, were getting these huge chunks of cash, whether it's stimulus checks, whether it's unemployment checks, and businesses have all this money to create new jobs, to create new products. That means all of a sudden, there's products out there, new products, new stores, and I got the money to spend. This was a field day for the economy. That's why we see the economy boom then in 2020. We saw it boom in 2021. We saw it boom in 2022. And then once interest rates started to rise, it started to slow down. Now here we are in 2023 and everybody's wondering, are we going to continue to see an economic slowdown with the higher interest rates? Are we going to continue to see an economic boom? But this is where now, going back to the job market, you have to remember, no market, whether it's the stock market, real estate market, crypto market, gold market, no market can go straight up forever. No market will stay in one place forever. Today, we are in an employee-favored market. Employees have the upper hand because there are more job openings out there than there are employees. That means employees have more negotiating power. But that doesn't mean it's going to always stay like that because the Federal Reserve Bank is working to pull money out of the economy. They're working to raise interest rates. They're working to cool down the economy, and they're working to soften the labor market. They say that. What does softening the labor market mean to you? Softening the labor market means it can't be so tight. It's tight because, well, there's so many people, so many businesses that are looking for people. But if there's not so many businesses looking for people, there's not that many job openings out there. Now, there's more people looking for jobs than there are jobs. That would mean then the upper hand would go back to the employer. So what I want you to remember now is right now, employees have the upper hand. But it won't always be like that. And when it shifts back to the employer, if you live in a utopian world where you think everything should be your way and you're not willing to put in extra work and not willing to do the work, then things will get a lot more difficult, especially in the job market. Because if things were to flip, where the economy slows, people don't have jobs, and now only a few companies are hiring, who do you think the employer is going to want to hire? The person that's going to just keep complaining and not want to do the work, or somebody who's going to be willing to do the work? And that's a decision or a thought you might not have to worry about right now, but it's something you want to understand because job markets change, assets change. Nothing can go straight up forever, and things don't go straight down forever. And right now, the job market is starting to change. We've been seeing the layoffs. We've been seeing the cooling in consumer spending. We've been seeing the cooling in certain parts of the economy. And if that continues with higher interest rates, you have to understand that as an employee, if you want to maintain your health as an employee, you want to maintain your position as an employee, You have to be able to continue to provide value to the employer, because what happens when you see economic downturns is employers start to demand more productivity. Why? Because their costs are rising and their revenue is falling. So they're going to be doing layoffs. And when they do layoffs, guess who they want to keep? They want to keep the top performers. So understand that no job market can stay in one place forever, but I want you to understand how the job market is shifting. That way you can make the best decisions for yourself, your family, and your community. It's a little ironic, but the things that create a booming economy are the same things that create a broke American. And what we're seeing happen today is more and more Americans are starting to go broke. Our economy runs on spending. When you spend all of your money, the economy booms. When you go into debt to spend more money, the economy booms even more. The more money you spend, the richer somebody else makes. Well, today, we're starting to see a shift in the way people can spend. We recently got some new economic data that says that consumers are strong, but that consumer spending is starting to slow. Let me actually take it one step further and read you directly from what Jamie Dimon, who is the CEO of JP Morgan Chase Bank, had to say. The consumer is in good shape. They are spending down their excess cash. This is why we have booms and busts in our economy. Our economy runs on spending, but then beyond that, we live in a credit-based economy, which means people have the ability to spend not just based off of how much money you earn, but based off of how much credit you qualify for. If you make $50,000 a year from your job and there was no credit, the maximum amount of money that you could spend is $50,000, which means the most you could stimulate the economy is $50,000. If you only spent $10,000 out of your $50,000, that might be good for you because now you saved that 40 grand. You might be investing that 40 grand to build your own wealth, but that's not so good for the economy because that means Chipotle is saying, hey, give us some of your money. Gucci is saying, give us some of your money. Apple's saying, don't you want to buy some more AirPods? But now if you flip things around and you spend $40,000 and save $10,000, now Gucci's saying, hey, thanks for buying our handbag. You want a belt too? Apple's happier because you bought their AirPods. Maybe you want to buy their phone too. Chipotle is saying, hey, you want to buy some more double guac? But then if you take it one step further, where now you make $50,000, but you can qualify for an additional $25,000 worth of debt. Maybe it's a line of credit. Maybe it's a home equity line of credit. Maybe it's a credit card. Well, now you could spend all $75,000 and now you're really stimulating the economy because now you are spending money like crazy. You're walking into the Gucci store, you're buying the handbag, you're buying the belt, you're buying the hat too. You go into Chipotle and you say, you know what? Let me get the double guac and the double meat. Actually, you know what? Give me a side tort too, because now Chipotle is charging for their side torts as well. And now you're really stimulating the economy. This is where now you have to understand as a consumer, as an investor, as a person, how this economic system works, because our economic system runs on spending, but also how our economic system is changing, because we're seeing changes happen right now. And these changes can also create more opportunities. So now the natural next question is, why are consumers slowing? Now, obviously, we know the inflation part, but there's two parts that aren't so well understood. Number one is that Americans have less ability to save. And number two is that Americans are tapping into their savings and these savings are being depleted. Let's start by taking a look at how much money Americans save. This data is from the Federal Reserve Bank, and what you'll see is that back in May of 2019, Americans were saving more than 8.5% of their income, which already wasn't enough. But if you fast forward to May of 2023, the average American was saving less than 5% of their income. Why are Americans saving so much less of their income? Well, probably due to the fact that we've had all this high inflation, making rent and your housing costs more expensive, making groceries more expensive, making vacations more expensive. So because of the higher cost of living, people have less ability to save. This brings us to the second factor, which is people now having to dig into their savings to continue funding all of their spending. Let me actually read you this excerpt from CNBC. This article was published in February 2023, and the title is, Amid Persistent Inflation, 54% of Americans are using savings to pay for everyday expenses. And then if you scroll down, it says, to make ends meet, 27% of Americans said they've had to take money out of savings, and more than half, or 54% of Americans, said that they've used that money to pay for everyday expenses such as groceries and rent. So on one hand, we have reports saying that consumer spending is strong, consumers are resilient, consumers are keeping the economy booming, but consumer spending is slowing. So the economy is strong because consumers are spending. But the red flag here is that consumer spending is slowing because consumers are ultimately what drive our economy. If people don't spend, the economy doesn't grow. If people are spending, the economy is growing. But ironically, when people spend, then you're going to hit a breaking point where people have to save because when you overspend, eventually you hit a breaking point. Eventually, you dig all the way through your savings. Eventually, you max out your credit cards. And when that happens, now instead of spending, you have to start saving. Instead of spending, you have to pay down your credit card debt. Instead of spending, you have to start building your savings. Now, these things, the building the savings and paying down your debt, is good for your wealth, but it's not so good for the economy. And this is where now you want to pay attention to this, because why is consumer spending slowing? Well, obviously, inflation is still a problem, but because of this high inflation, number one, Americans are saving less of their money. They have less ability to put money aside. And then number two, more and more Americans are now having to dig into their savings or go into debt to fund everyday expenses. Because now, when you see the higher cost of living, when you go into a restaurant, you see the higher cost of your bills. You go on a vacation, you have the higher cost of the flight. You have to go to the hotel, you have to pay more money for the hotel. Either you're going to say, you know what, we'll just put it on the credit card. I don't want to sacrifice this lifestyle that we've had. I've been liking going to these restaurants every Friday night. I don't want to stop doing that. Or you're going to say, something's going on here. The cost of living is growing very fast. I don't know if we can keep affording living this type of lifestyle. Maybe we should cut back. And for the average person, cutting back is way more difficult than just putting it on your credit card or digging it into your savings. And that's what we're seeing happen right now. Consumer spending is slowing because some people are digging deeper into their savings or they're tapping out on their credit cards. And there's only so much further that you can go. Once that excess cash, the excess savings, the excess debt ability goes away, that's when the consumer spending also goes away. And this is where a lot of people say, but what do you mean excess cash? How do people still have excess cash? How do businesses still have excess cash? This has been a year and a half since the pandemic really stopped. How is there still excess cash? And the thing that's difficult for a lot of people to grasp is the real amount of money that was created to stimulate our economy. There was a statistic that was put out by NASDAQ, which said that we spent more money stimulating our economy in 2020 and 2021 than we spent fueling all of World War II, even after adjusting the war numbers for inflation. So yes, we're seeing big shifts happen in our economy right now. They might not be showing up in the markets or in asset prices, but there are shifts happening in the economy. Some people are noticing, but these are gradual shifts. And that's what makes them so unique, because everybody expects changes in the economy to be drastic and dramatic. But we're starting to see this slow, gradual slowdown in spending. And if spending continues to slow down, eventually that's going to hit businesses' revenues. Because if people have less ability to spend, that means less people are going to go to Chipotle, less people are going to go to Gucci, less people are going to go to Amazon. And if less people are going to be shopping, that means businesses are making less revenues. And that's at a time where costs have risen. Why have they risen? Because of inflation. But in addition to that, we also have huge amounts of debts out there, corporate debts. And these corporate debts are not 30-year fixed rate mortgages. Remember, corporations loaded up on debt in 2020 and 2021. And these are many times adjustable rate debts, where every 3 to 5 years, these debts start to readjust. And what we've been seeing is that in the coming 24 months, we have a lot of corporate debt, a lot of real estate debt that's going to be readjusting. And when it readjusts, this debt is going to change depending on where interest rates are. And interest rates are significantly higher today than where they were 2 years ago, 3 years ago, which means if nothing changes on the interest rate side, that means corporations are already going to be facing higher prices because of inflation, but then number two, they're going to be facing higher costs because of the debts. And if consumer spending continues to slow down because people keep racking up the credit card debt and they dig out of their savings, then there's going to be less ability for people to spend. That means lower revenues, higher costs. And this is where it becomes so crucial and important for you to understand this, That way you can capitalize on opportunities that might come your way. But in order for you to capitalize on these opportunities, that means number one, you have to understand what's happening. Number two, you have to be financially educated. You have to know how to invest. You have to know how to find the opportunities. You have to know how to invest in stocks, how to find good stocks, how to invest in real estate, how to find good investment properties, how to invest in businesses. And then number three is you have to be prepared. Because you can see the greatest investment opportunity in the world, but if you don't have any money to actually capitalize on it, it doesn't do you any good. That means right now, you got to get your money right. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. And that's why it's so important right now for you to get financially smart and understand what's happening. Because while we're not seeing this drastic shift in the economy today, what we are seeing is this gradual slowdown in spending. And if that continues, that's going to have more and more drastic effects on our economy. If your goal is to truly become wealthy, and by wealthy, I mean not just driving around in a paid-off Toyota Corolla, I mean having the nice things that you want, having the vacations, having the lifestyle that you want, you're not going to achieve that by just getting a 3 to 5% raise every year or by maxing out your 401k. I'll show you. Wealthy people become wealthy not because of the income